Hello, fools, and welcome to the Millionacres Hour. It is 2 o'clock Eastern Time. I'm Deidre Woollard. I'm here with Kevin Vandenboss, who is a contributor over at Millionacres. And as I mentioned, today our interview is with Ed Pitoniak, who is VICI's Chief Executive Officer. And we'll get him live in just a second. He previously served as vice chairman of Realterm, which is a private equity manager. And just a little bit about VICI Properties. They have 28 gaming facilities that includes 47 million square feet. So hotels, restaurants, bars, nightclubs, all of that, sports perks, all of that Vegas stuff you think about Vegas and elsewhere. And the properties, VICI is the REIT, and the properties are leased to industry-leading gaming and hospitality operators, biggies like Caesars Entertainment, Century Casinos, Hard Rock International, Jack Entertainment, and Penn National Gaming. So welcome.
Thank you, Deidre. Good to see you, and good to see Kevin.
Hey, thank you.
Well, let's get right into it. What is happening in Las Vegas right now, and what are you seeing in terms of reopening?
Yeah, it's been a really interesting 14 months. A year ago this time, obviously the assets were closed. And in fact, I think at this point in early May, it wasn't even clear when the Las Vegas assets were going to reopen. And they didn't really start to get reopened until I think it was later June. And obviously had to operate under quite severe capacity restrictions for much of the rest of 2020 and even into early 2021. And what has been so gratifying to see for our operators who have been working so hard and working very hard all this time to operate safely is that business really started coming back in March. And that was obviously a function of a few things. Obviously, vaccination had started to achieve critical mass here in the US. And I also think, frankly, by then, Deirdre, the US consumer was ready to get the hell out of the house. Yeah. And that trend has continued into April. I just happen to have CNBC on the background, and they did refer to a number of operators saying that April is the best month they've had since 2013 in Las Vegas, which is really remarkable because so far, of course, Vegas is really relying principally, if not almost exclusively, on the leisure traveler, right? The convention and trade show business hasn't quite fired back up yet. It's going to very soon, starting in June. But clearly here in the US, we've got a lot of people who feel, rightly so, I've been locked up for a long time. It's time to bust out. And Vegas is probably, I'm speculating here, Deirdre, but I'm guessing Vegas is probably the hottest tourist destination in the US right now. Because the great tourism cities like New York and San Francisco really aren't still seeing tourists. Orlando's obviously seeing tourists as Disney World begins to reopen. But that's a family-based tourism experience. And I think Vegas right now is leading the way in terms of the leisure recovery in the US.
Makes sense. A good point about conventions too, that they're coming back slowly starting the next couple of months. What about international travel? Obviously, in the US, we're not traveling internationally, which is probably good news for Las Vegas, but are you seeing any international travel come to Vegas or not quite yet?
We're not hearing about a lot of it, and for exactly the reasons you cite. I mean, the truth is most of the countries around us are still struggling. I mean, Canada, as an example, where I lived for many years, is really having a tough time. And European inbound travel is obviously not robust yet by any means. So I do think it's going to be a while. Maybe it's in 2022 that Vegas starts to see meaningful recovery of international travel. But I don't think Vegas is going to pay a price for that through the rest of 2021 and even into 2022, because Americans are going to be going nuts.
Hey, Ed. So you guys have a fair amount of land along the strip there in Vegas. And I'm curious, what development opportunities are you guys exploring on that right now?
Yeah, so Kevin, We own 27 acres that we call strip adjacent. It's acreage that exists right in back of assets like Harrah's Las Vegas, Flamingo, Link, Cromwell, Bally's, Paris, Planet Hollywood, right along the back edge of all those buildings on the east side of the strip. We own 27 acres, and Caesars has another 23 that are largely undeveloped. We actually had an agreement a year ago that we would buy that 23 acres, but we had to table that for a few reasons, COVID being one of them, but secondly, because there are some entitlement and encumbrance issues around that. But eventually that does represent developable land. Probably the most compelling land that we VICI own in Las Vegas is a 7-acre parcel, actually within the 82 acres of Caesars Palace, Las Vegas. This is 7 acres. It sits at the corner of Las Vegas Boulevard, otherwise known as the Strip, and Flamingo. And right now, it's perhaps the most underutilized 7 acres in American commercial real estate. There's a limo parking lot. There's a tent. There's like a beer garden kind of thing, and some other assets that are giving a certain amount of entertainment to the guests. But this is 7 acres that could very easily accommodate a new podium, a new tower, could be the first asset on that western side of the strip to actually have truly strip front gaming. If you know the strip well, you know that the east side assets are actually all right up against the sidewalk, and you can walk right from the sidewalk into, or onto, I should say, a casino floor. The west side is more of a suburban model. All the houses, if you will, are set way back from the street. So it's a long walk into City Center. It's a long walk into Bellagio. It's a long walk into Caesars Palace, Las Vegas. It's a long walk into Mirage. Caesars, with its 7 acres, has the opportunity to bring gaming right to the strip on the west side. And Caesars has certainly over the years been working on some very compelling designs to densify and animate that corner.
Oh, sounds exciting.
It is.
Well, that's interesting. Are you seeing a lot of development from other hotels, other venues on the Las Vegas Strip right now, or is it still? It seems like development has slowed a little bit in recent years.
It has actually, Deirdre. Vegas saw very little. Well, no, I shouldn't say very little. Basically, zero supply growth since 2010. That came on the heels of a massive upsurge in supply, unfortunately coming right into the great financial crisis. And this would have been in the form of assets like Cosmopolitan, like City Center, like the new Wynn assets, obviously. And then it all went quiet. We will see, I think within the next month or two, the opening of Resorts World, what looks to be a very compelling property developed by the Asian gaming company Genting. That'll represent the first new supply to have opened in what will be then 11 and a half years. What's interesting, though, and exciting, and it speaks to how promising the future of Las Vegas is, that there's been news just recently. Well, there's really been 3 items of news. The first came within, I think, the last month or two, when Koch Industries, which are quite famous for being very shrewd allocators of capital, announced that they are coming in to help revive the Fontainebleau project that started just as the financial crisis was commencing, had to be mothballed, and now what I guess will be probably 12 or 13 years later is going to see a full revival of the development with the original Fontainebleau entrepreneurs and Koch Industries capital. Again, we think a pretty ringing endorsement of the outlook for Las Vegas. You also have seen just in recent weeks, Hyatt announced that it's going to come into the Rio asset, which is just over the highway from the Strip. And that's indicative of the fact that major hotel brands like Hyatt recognize Vegas is a place they have to be if they're going to be a highly relevant U.S. hotel brand, both for the leisure traveler and the convention business. And then finally, you saw just this morning the news break that the San Manuel tribe, which is one of the most successful tribes in American gaming, is going to buy the Palms from Red Rock. And we'll be bringing all the very loyal customers that they have, obviously east of LA, to Las Vegas as well. So the Rio and the Palms are not development projects per se, but they do speak to the extent to which new capital wants to come into Vegas.
Interesting. I've been following that Fontainebleau project for a long time. That's been quite a journey, but it's interesting that now we're in this period of revival in Las Vegas.
It is, and I think there's a number of factors that are contributing to it. First of all, it's just a phenomenal tourist destination, right? There is so much that goes on there. We recently announced, obviously, the acquisition of the real estate of the Venetian. The Venetian is 8 million square feet. The Venetian did $1.8 billion of revenue in 2019, which we believe, because we haven't been able to find any asset that outproduced it, is the most revenue produced within a single real estate asset in America, right? And how do you produce $1.8 billion of revenue in an asset like that? Well, you don't, in their case, do it solely through gaming. Gaming is about 20% of the revenue in that asset, or at least it was in 2019. The other big drivers are obviously the convention business, which represents an enormous part of the business at the Venetian, given that it has 2.3 million square feet of convention space. It's the largest privately owned convention center in America. When you get convention visitors, trade show visitors, CES announced they're coming back to Vegas live and in person in early January, and you get leisure travelers, you get the highest occupancies in America, right? Coming into COVID, the big Vegas Strip assets were running 90% plus occupancy. I've run 2 hotel REITs. I cannot tell you how hard it is to run 90% plus occupancy, because the unfortunate dirty little secret of the hotel business, every night of the week weighs 14 points. So the toughest night of the week, obviously, in the conventional hotel business is Sunday nights. You can't give it away on Sunday nights. Well, you know what? In Vegas, not only do you not have to give it away, you can charge for it, because it is a destination where the entire infrastructure, whether it's airlift, the taxi fleets, the room count, the entertainment options, add up to, again, the most compelling, grown-up tourism destination in America, bar none.
How is that Venetian deal coming along? I remember reading you guys were looking at the second half of 2021. Are you still on track for that?
Yeah. Yes. The big task during this period is for Apollo, certain officers of Apollo, to be licensed within Nevada, which is what everybody has to go through in order to operate a casino. But no, we're very confident we're on track for that. Very excited by the opportunity to steward, what Sheldon Adelson built there. So again, very, very positive about that.
That's a huge deal, and want to definitely congratulate you on that.
Thank you.
Phenomenal.
Yeah. Well, and Apollo, our partner, Apollo's been busy. You saw the news about buying AOL and Yahoo yesterday. Mm-hmm. And David Sandberg, with whom we worked on the Venetian deal, was just on CNBC talking about AOL and Yahoo. And this ties, if you don't mind, it ties to, I think, a really critically important topic in understanding gaming as a consumer sector right now at this particular time within the US economy and within US culture. And the big tailwind that's emerging behind gaming right now in America is sports betting, right? It wasn't too long ago where the only place you could do it in America was Las Vegas. We're on track now to have at least a couple dozen states having legalized sports betting. There's very avid discussion in places like Texas and Georgia and elsewhere to add sports betting. It's being added in Florida as we speak. And the way we as a real estate owner think about sports betting isn't so much about the direct revenue that sports betting represents. It's the fact that sports betting gives America's gaming operators a chance to engage in one of the two great conversation topics in American culture day to day. One of them is weather, and you can bet on weather in the commodities market. And the other is sports, right? So if we think about gaming as a consumer discretionary sector, right? In order for gaming to increase its share of consumer discretionary spending, both the spending of time and money, you have to first grow your share of mind, because you want the consumer to be thinking about, well, yeah, I want to go to Las Vegas, or I want to go to New Orleans, I want to go to Lake Tahoe or Atlantic City when I have an opportunity to spend leisure time and money. But you're not going to be top of mind unless you have grown your share of voice, so that you are sending out messaging that engages and activates the consumer and makes you top of mind. Well, the conventional paradigm of gaming, like the conventional marketing paradigm of so many businesses, was tied to things like direct mail. Well, I don't know, but I swear my daughters, I don't think they even know where their physical mailboxes are, because in their minds, they never receive anything of consequence in a physical mailbox. That's just not the way it works anymore. So it's very opportune that sports betting comes along at a time when, for gaming, it can be the new way of communicating with potential and existing customers, right? Every day on ESPN, thanks to Caesars' exclusive partnership with ESPN, Caesars gets cited as the source of all the sports betting information on ESPN. Caesars is going to be the official sports betting partner of the NFL. Penn, one of our other big tenants, owns Barstool. They're controlling interest in Barstool. When Penn sends out messages to the 66 million members of Barstool Nation, right, it is achieving a level of communication and engagement it could never have dreamed of under the old paradigm. Just could not, right? So this is, again, where we are so excited, more excited than ever, about the business of our tenants, because our tenants have picked up a secular tailwind, a technology-enabled secular tailwind that should greatly increase, again, their share of market in American consumer discretionary. And as you all know, Deidre and Kevin, right now, this is the one time when the conventional wisdom is right. And the conventional wisdom says the American consumer is going to go pretty crazy for a while here.
That's very true. Wondering about gaming in terms of sports betting, what opportunities in other cities does it open up for VICI and for other companies?
Yeah, well, sports betting, to your point, Deidre, sports betting is woven into an increasing acceptance of gaming overall, and an increasing adoption of gaming within new jurisdictions. So as an example, Virginia is now really starting to get into the gaming business. Our tenant Caesars has the opportunity now to develop a new casino in Danville, Virginia, which we will actually have a right of first refusal on should they ever want to monetize the real estate. And you're also looking at bidding processes for new casinos in Richmond and Norfolk, I believe it is. Similarly, you're hearing noise around other states as well that either want to enter the gaming business or expand the gaming business in their states. In some cases, you're talking brick and mortar and sports betting. In other cases, sports betting is proving to be the gaming water that states are dipping their toes in first.
Interesting. I have a related question. We've seen obviously gaming increase a lot. We're also seeing cannabis laws change in different states. I know Las Vegas is sort of developing a kind of cannabis as a destination for cannabis entertainment and sales in some ways. Is that something you're looking at as well?
No.
Interesting.
And one key reason is because many gaming jurisdictions do not allow licensed participants in the gaming industry in those states to be in any way, shape, or form associated with the cannabis business, legal or otherwise. So that is a simple no in our case.
Now with this, you're kind of, talking about a bit of a changing landscape in the gaming industry. And with that, are you expecting to see more companies, enter the gaming real estate space?
Yeah, Kevin, and we started to see it in late 2019 when Blackstone's privately traded REIT, non-listed REIT known as the B REIT, came in and bought the Bellagio at a very high price, a very low cap rate, but in fact, we think bought a phenomenal piece of real estate at a very attractive price. So Blackstone was really the first non-gaming REIT to come into gaming real estate. And then they doubled down, if you will, when they bought with MGP, another gaming REIT, bought the real estate of MGM Grand and Mandalay Bay back in January of 2020. Okay, so we were starting to see this incursion of new capital into gaming real estate and thus the validation of gaming real estate by great institutional investors like Blackstone. And then, of course, COVID hit and it all went quiet. And we obviously with Apollo were the first to make really big noise as we begin to recover from COVID with the Venetian deal. But I think what you will see is a continuing realization on the part of institutional real estate investment managers. The gaming real estate represents very, very attractive returns relative to all of their other investment opportunities. I'm sure as a lot of your viewers and listeners understand, one of the fundamental ways of talking about real estate value is in terms of what's called a cap rate. And just in case anyone doesn't know what a cap rate means within real estate investment, it simply means the yield you get on your investment, right? So if I buy a building and it's going to pay me $6 of rent a year and I've paid $100 for it, I've paid what's called a 6 cap for it, right? Because I'm paying $100, I'm getting $6 of rent, thus a 6% yield. Thus, I've paid a 6% cap rate. Well, as it happens, we paid a 6.25% cap rate for the Venetian. To put that into perspective, if you want to buy an office building in New York or San Francisco or Chicago, you're going to pay a cap rate that probably starts with 4. And you're going to wonder, why am I doing this exactly? Because I have vacancy risk. I have this new thing called work from home. I have my tenants saying, I'm not going to need this much space anymore. They may already be subletting it and competing with me to lease any space I have to lease as a landlord. And then when somebody moves out and I have to bring a new tenant in, I have to spend the CapEx on their tenant improvements. So my honest yield here is not very attractive. So it's not going to take too long for people to realize, geez, gaming real estate, especially when we buy it as we do on what's called a triple net basis. Wow, this is really good. And then this is probably not a primary concern of your members, but a lot of capital in the equity markets gets invested by pension funds and endowments that have to think in terms of long dated liabilities, right? So if I'm a pension fund manager, I have to be asking the question, where does the income come from 40 or 50 years from now that must be distributed to my pensioners, to the people I work for, right? Am I just going to trade in and out of stocks for the next 40 years? Like that's a lot of pressure to get it right. On the other hand, is there an equity asset I can buy that has a business model that's actually designed to deliver value 30 or 40 years from now? Well, our leases effectively run 35 to 50 years. And the rent we collect today is going to escalate on an average basis, on an average per share basis of around 2%. And we also have, which is fairly rare among REITs, we also have CPI kickers. right? So in many cases, our leases call for the hire of either 2% rent escalation per year, compounded obviously, or CPI, whichever is higher, right? So again, I realize it may not be a super hot topic among Motley Fool members, but for a lot of institutional capital, I think there's going to be a growing recognition that, oh, I like this. It's a really long dated asset, 35 to 50 years. The income escalates and has CPI protection. So I actually, in real terms, I'm pretty confident I will get a real return above inflation for the next few decades. And so that's probably going to lead to increasing investment in the equities of REITs that own gaming real estate. And it could even lead to the day when pension funds start owning these assets directly, right? Among America's biggest real estate owners are, among others, Canadian pension funds, right? They have these massive direct investment arms, Oxford Properties, Ivanhoe Cambridge, Cadillac Fairview, that quietly own a bunch of buildings around wherever you happen to work or live.
Interesting. I want to ask you about acquisitions. You've acquired 14 assets over the past 42 months. Are you looking at deals right now? I know there's a lot of capital out there looking for distressed assets. Is that something you're thinking about?
Well, we would be if our category was in distress, but it never happened, right? I mean, our operators, our regional assets, Deirdre, by July or August, having reopened, a number of our regional assets in 2020, in July and August of 2020, were doing more in operating profit than they had the year before. They were usually running less revenue because of capacity restrictions, but these operators are such great operators. So we don't have any distress in gaming. There may be opportunities outside of gaming where we can help as a capital source where there has been distress. But to your point, we've been very busy. We've done $12 billion of acquisitions in the roughly 40 odd months we've existed. We've raised more equity than any other REIT in America during that period. We've raised $8 billion of equity in the open market. And we have a business model that enables us to be continually forward-looking. It is, I do feel, Deirdre, like I died and went to business model heaven. So over the period you're asking about, we've increased our rent, which because of our triple net structure means we've increased our net operating income by $1 billion. Our cash G&A during that period has increased by about $1.5 million, right? So $1 billion of new net operating income, $1.5 million of increased cash G&A, right? It's just a wickedly efficient business model. And because we really don't have to property manage, we don't really have much of an asset management function of the actual physical box, we're free to just keep going and looking for opportunities to help people out with capital. So yeah, we're very busy continuing to look at opportunities. And we have, importantly, I think for your members, Deirdre, we have what we believe is the biggest embedded growth pipeline among all of American REITs. And what I mean by embedded growth pipeline is that we have a package of either right of first refusals or put call agreements that enable us to continue to buy assets over the next few years. And to give you an example of that, starting on January 1st, 2022, which used to seem like a long way away, but now it's whatever it is, 7 months away, seven plus months away, we have the opportunity to call 2 assets in Indiana from Caesars. We can call them at 7.7% cap rates, very attractive. If they wanted to, they could put them to us at an 8% cap rate, which would be more attractive. That constitutes growth. That can constitute growth in 2022, on top of the growth that the Venetian will give us in 2022, given its closing in late 2021. And then beyond that, we have 2 right of first refusals should Caesars decide to sell 1 or 2 Las Vegas Strip assets. They believe they're oversupplied on the Strip. So they're looking at probably in 2022 selling at least one asset. That's more growth for us. We have a put call arrangement on the brand new Caesars Forum Convention Center, which will host the NFL draft at this time next year, which we can call at a 7.7 cap beginning, I believe, in 2024. And then we have other ROFRs above and beyond that. So we have a growth trajectory going forward that we don't think is frankly equaled by any other REIT in America that we can think of. And it all adds up to, continuing deal flow, continuing growth in AFFO per share. And AFFO, as many of your members may know, is the mother's milk of REITs because it represents real cash, not notional net income, but real cash that we can then distribute to our shareholders.
So last year, you guys had expanded outside of gaming a little bit with a mortgage loan to the Chelsea Piers. Are you open to doing other investments like that? Other things a little bit outside of the gaming space?
Very much so, Kevin. And the reason being, we believe in, and we believe this well before COVID, we believe in experiences versus things, right? And if you look at American consumer behavior over much of the last 20 years, you will have seen a growing preference on the part of the American consumer for experiences over things. And one thing we really like about experiences is that they are not under the secular threat that almost all things are under when it comes to real estate and the relationship to those things. And the way we put it, Kevin, is that we want to be in sectors that can't get Amazoned. If you sell something that can be put in a box or sent through a wire, you're in danger of your real estate becoming obsolete or at least of less value, right? Mm-hmm. And that obviously applies to a whole bunch of things that get sold in stores. It also applies to certain kinds of experiences that are subject to disruption, movie theaters being one of them. Amazon and a whole bunch of other people have figured out how to send movies through a wire to your house, right? And what that means for the enduring viability of movie theater real estate isn't known at this point. It's not that they're all going to go away, all the movie theaters, but for every 100 that existed before COVID, do you guys have a sense of how many might exist when this all shakes out? Right? Yeah, I don't know either. But I do know that there are place-based experiences where the place cannot be substituted for. Can't be put in a box, can't be put through a wire. And as we look at those experiential sectors, we see many of the same investment attributes we love so much about gaming. Lower than average cyclicality versus consumer discretionary. Gaming is actually a lower cyclicality activity in consumer discretionary, believe it or not, right? Gaming was down only 9% peak to trough in the US during the great financial crisis. Restaurants or retail were down 11 and the S&P 500 revenues were down 18%. Right? So we like lower cyclicality. We don't want secular threat. We want healthy supply-demand balance. So we tend to prefer assets like Chelsea Piers that are complicated and costly to build. And then finally, number 4, experiential durability. Experiences that have proven their durability over time and promise to be here for many years to come.
That leads me to another question. I wanted to ask you about esports. Is that something that you see as having potential in terms of facilities, or is that something you feel like maybe is a passing trend?
Wow, it's gotten so big. It's hard to imagine how it could be, Deidre. I know pre-COVID that the whole esports business globally was, I don't know how many multiples greater than the movie business, but a lot of multiples greater than the movie business. That was pre-COVID. I have no idea what it is now. And so to your question, Deirdre, one of the other reasons we're very excited about our Venetian real estate acquisition is that on the back lot of the Venetian is being built what will be the most compelling esports venue in the world, that being the MSG Sphere. It is costing Madison Square Garden, the company, $1.8 billion to build it. It's going to be an 18,000 seat arena, not designed for team sports, but designed for esports and music, and will be the most technologically sophisticated arena by far in the world. And we're very excited what that can mean in terms of Las Vegas having yet another tool, in addition to sports betting, to attract its next generation of customers. Now, I'm a really old guy, Deirdre, so I have to confess, I totally don't get 18,000 people sitting in an arena watching other kids their age play video games on stage. But I'm just willing to accept the fact that they seem to love it and bring it on.
Yeah, it's not something I understand either, but it definitely seems to be growing massively.
Kevin, do you?
I don't get it, but I know I've seen my kids watch hours of YouTube videos of other kids playing Minecraft. So,
oh yeah, it's like it's another example of the Amazon Midas touch. They buy this thing I've never heard of called Twitch, and the next thing you know, Twitch is one of the more valuable parts of the whole Amazon platform, which is pretty damn valuable to begin with.
Well, great. Well, thank you so much for your time today. This was really, really fascinating and such a treat for our viewers.
Oh, my pleasure. One thing I didn't mention, Deirdre, that may be of interest to your viewers is that, the ability of a REIT to grow its dividend is obviously dependent upon the ability of the REIT to grow its income, right? Because that's what a REIT does. It distributes its income. We were able to put forth one of the larger dividend increases of any large cap American REIT last year at 10.9%. And with the growth in distributable cash that we're enjoying so far this year, we just reported last week, 24% growth in distributable cash. We should be in a position to put forth a very nice dividend increase this year when we do so, as we typically do in Q3.
Fantastic. And so you distribute your dividends quarterly?
Yes, we do. Yep.
Fantastic. Kevin, any last thoughts?
No, I think you answered everything that I've been wondering, and I think you guys are doing a great job. I mean, I know you guys, it's exciting watching what you guys are doing. Congratulations on all that, and I can't wait to see what you guys do the rest of the year.
Well, we're having a lot of fun, Kevin, and maybe one of the last things I'd leave you with is that, if you look at a chart of our stock, you could sit there today on May 4th and I never look at our price intraday, so don't even tell me what we're doing today, but you could look at our stock over the last few months and go, oh man, I kind of missed it on VICI. You haven't missed it, because if you are a devotee of that old school metric like I am, the price earnings growth ratio, you always want to understand, what am I paying for the growth I'm getting? And in the case of VICI, oh no. Am I still here?
You're still here.
Yeah. Sorry about that. In the case of VICI, we have one of the lowest PEG ratios, probably the lowest PEG ratio of any large cap REIT in America, right? It's probably going to be pretty close to 1-to-1. And that's at a time when most other REITs are well above, probably well above a 2-to-1 PEG ratio at least. So you haven't missed the run, because we have a lot of growth to come that is not yet priced into the stock.